Hello traders, and welcome to this video in which we will discuss the strategy. Furthermore, we will discuss ways to improve the success probability of the trades that we are taking based on this strategy. The basic rule of the strategy is that we are taking trades only at the volatility levels, which are these lines that we see on the chart. There are two yellow lines, the lower yellow line and the upper yellow line. The pivot, which is between the two yellow levels, and the resistances, which are above the upper yellow level, and the supports, which are below the lower yellow level. So we have specific trade parameters in order to take trades, and these are the maximum distance that we can take trade from a level is at 1 point. The stop is 2 points on the other side of the level. So for example, if we were to take a trade at this level, at 53.44.25, we could take the trade at maximum distance at 53.44.25 minus 1 point, so at 53.43.25. The stop will be 2 points above the level at 53.46.25. And the natural target is the next level at the side of the trade. But of course, we can't. We want to always wait for the next level. We will be scaling out as price will be moving towards the direction of the trade. A level breaks when the index goes at the distance 2.25 points above on the other side of the level. So here, the index hit the upper yellow level and went at a distance greater than 53.44.25 plus 2.25, so larger than 53. It tagged 53.46.50. That automatically means that the level has broken to the upside, and at this from that point we are looking for longs at the level. So basically the thing is this: if we have taken the short here, we will have been stopped. And also if we have taken the long here, after the index broke above the level, we would again have been stopped. How we can filter out these failures in order to improve the success rate of the strategy? We can do this by using the exponential moving average of 21 periods on the chart. The chart is of 2000 ticks. Be careful because this isn't a time chart, it's a tick chart. And the basic rule is that first of all, we cannot take trades to the short side when the index is trading above the EMA. And in the same manner, we cannot take the trades to the long side if the index is trading below the EMA. We want to take trades only to the long side if the index is above EMA, and to the short side if the index is below EMA. Furthermore, we won't take trades only if the index is at maximum, if the EMA is at maximum distance of 2 points from a level. So here we see that EMA was at 53.42 when the index hit the upper yellow level. So this is more than 2 points from the level, and this automatically means that we cannot take this trade. We want EMA to be closer. Here we see that the index was trading above EMA, and that means we shouldn't take the short here because we were in a trading up situation. So here we wouldn't have taken the trade, but we would have taken the trade also here because the index was trading above EMA, and again here we would have taken this trade either because EMA was a distance more than 2 points from the upper yellow level. So we are filtering out 3 trades. 2 of them were failure, 1 was a success, but this doesn't matter. Let's go here that the index this went down to the pivot, near pivot, at 53.22.50, but it didn't quite touch it. and then it started trading up. We see here that it was trading above EMA. It hit the upper yellow level while it was trading above EMA. This wasn't a short because the index was trading above the EMA, and then it broke above EMA, above the upper yellow level, by tagging 53.46.50, 2.25 points above the level. Then it went down to the level. We see here that EMA is at 53.42.25. It is at 2 points distance. So here this was a valid trade, and this was a long that worked well. It went up to 53.50.75. It gave 30 points gain. So we had one trade here. This happened about 45 minutes after the US Open, and then this came down again. We see here that it touched again the upper yellow level, but this time it was below the EMA, and that means that we wouldn't have taken the trade. But here's a caveat. The index was trading above below the EMA at the time it hit the upper yellow level. In order to be trading below the EMA and therefore being in a downtrend, it would need to have one full bar. One full bar means both the wicks and the body below EMA before touching the entry at the level. The entry at the level is, as we have discussed, at maximum 1 point above the level, at maximum at 53.54.25 plus 1 point, so at 53.45.25. So this was a valid entry because this bar was the first bar, full bar below EMA, but this bar triggered the entry. The entry wouldn't have been triggered if we had a full bar and then another bar that would trigger the entry. This entry wouldn't have been valid. We see that this gave a reaction up to 53.41.25. It was 7 points. This is a successful trade because the stop was 2 points, and that means that it produced 3 times the risk. After that, it went down again. This again was a valid entry. It gave a reaction this time at 53.49.50, 55.25 points, and then it went down again. Of course, when we see a situation like this and the EMA start being flat, that means that it's better to stay away, because at this point we don't have a trend, we have a choppy sideways price action. And then we see that after a while the index broke below the upper yellow level, it tagged 40.50, and then it went up at 53.43.25. So it went at 1 point distance from the level. This triggered the short, and the short drove the index down to 53.33.0. It gave 10 points. Then after that, we see that the index went up again. We see this bar. This bar triggered the short. We don't have a full bar above EMA, so we don't have an uptrend yet. This again was at 43.25. This triggered a short that gave a reaction down to 43.35.75. It gave a 9 points reaction, and then it went up again, this time at 43.47.50. It broke above, and then here was a hit of the upper yellow level from above, but it wasn't an entry because EMA was at 43.41.50. It was more than 2 points from the level, and therefore this wasn't a long. After that, we see that the index dropped again below the EMA. It went above the EMA. We see that it is starting to move sideways, and that means that most likely we will have a shift in trend to the upside. So it's better to abstain from shorting again. We see that the index, after that it broke above, it went at 4350.25. Therefore, above the 44.25 plus 2.25 points. That means that it is required in order for the level to break to the upside. The index gave down nicely to the level. EMA was at 53.43.25. It was less than 2 points distance from the level. This was a textbook long that took the index up to 4366.50. It gave 21 points rally, which was pretty nice. And then we see that the index started coming down again. We see here that the index dropped below EMA, and then it had a full bar below EMA. Since we have a full bar below EMA here, then we are in a downtrend. That means that if the index hits the upper yellow level, hits the entry at the upper yellow level, this means at one point above the upper yellow level at 43.44.25 plus 1 point, at 43.45.25, then this isn't a valid long. The index didn't manage to get there anyway and started moving up again. So, the basic rule of the year strategy is that we are entering only at the volatility levels. The volatility levels consist of two yellow levels, the upper yellow level and the lower yellow level, the pivot, which is the red line of the chart, the resistances, which are above the upper yellow level, and the supports, which are below the lower yellow level. The entries, the trade parameters are entry at maximum 1 point distance from the level, stop at 2 points distance on the other side of the level, and a level breaks when it acts 2.25 points on the other side of the level. Generally, below the lower yellow level, we are in a bearish situation, and above the upper yellow level, we are in a bullish situation. This doesn't mean we cannot take shorts in a bullish situation or longs in a bearish situation. It all depends on the relative positions or position of the index with respect to the levels and the EMA. The EMA filters out a lot of bad trades and increases dramatically the success ratio of the year strategy, and it's doing that in a simple way. First of all, if we are going to long, we cannot have EMA at a distance more than 2 points below a level. Equivalently, if we are going to short, we cannot have EMA at a distance more than 2 points above the level. And moreover, we cannot short when the index is in an uptrend above EMA or in a downtrend below EMA. In order for the index to get in an uptrend above EMA, it needs a full bar above EMA, or in order to get in a downtrend below EMA, it needs a full bar below EMA. If the index drops at a level below EMA, but the entry is triggered before the index completes a full bar below EMA, then this entry is valid. And in the same way, if the index gets above EMA, but it triggers the entry before it completes a full bar above EMA. Basically, we can have a full bar above EMA and still be a short if this full bar triggers the short. If this full bar doesn't trigger the short, then we must cancel our sell orders. And in the same way, when the index is dropping at the level and gets below EMA, the first full bar below EMA must trigger the long. Otherwise, we must remove the long orders. So in this way, with the EMA, we can filter out a lot of bad trades and increase dramatically the success ratio of the year strategy. The levels are excellent, very precise, because they are algo generated and therefore they are objective with zero subjectivity. But even in this situation, there are occasions where the index is chopping around in a sideways move, and therefore we need to know how we handle these situations. Keep in mind that when the volatility increases, the trade parameters will double. That means that the entry will be at maximum 2 points from the level, and the stop will be at 4 points on the other side of the level, while the level will break in this situation at 4.25 points on the other side of the level. When we double the trade parameters, when the distance between the volatility levels is more than 15 points. And the previous day we have a very big drop, or a drop that is much bigger than what the index was doing the previous days. So I hope this makes sense and you enjoyed this video. If you have any questions, you can leave it in the comments below or message me at Twitter or in Slack if you are members of the service.